Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. I'll introduce Rob here in just a few moments, but as always, we need to cover off some important housekeeping details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available to be read in full detail on our website, or feel free to take a screenshot of it if you like, but that's the main point to take away. So for this session, as you'll see circled on the screen, we only have one method of asking questions, and that's going to be through the Q&A window. So we are live streaming to multiple different platforms at the moment with the understanding that we're live streaming to Facebook, YouTube, Twitter, and then of course our Zoom audience. We are going to have a brief question portion at the end of the session. Rob goes through his presentation, has a couple case study considerations, and then with the time remaining, we'll open it up to some questions. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time. With that, if we don't get to your question, take that as encouragement to attend the insiders meeting when there's a 45-minute portion of the session solely based on answering questions for subscribers. So obviously a much higher likelihood of getting your question addressed on that session. Lastly, we have the chat window as well. Any support related queries I can handle in there, or for any interaction amongst other attendees, please feel encouraged to use that window. Just make note that by default, the bottom changes to host and panelist. Be sure to change that to everyone. That way your message will be visible for everyone on the webinar. Well, the market can't seem to break above 420. Perhaps it's due to waiting on the July GDP report. So anxious to hear, that's due tomorrow, and anxious to hear what Rob's thoughts may be on that, along with all your great questions and comments as always. So at this moment in time, I think that covers off all the important details. So I'll introduce the man of the hour. That's Rob Roy.
Thanks, Zach. Hey, everybody. Welcome to this week's TradeFinder Live. Welcome to all of you on all the different social media platforms. Crazy world that we have now where we can broadcast to all of them at once. Pretty amazing stuff. And to all of our regulars on Zoom, welcome to you as well. I'll go ahead and turn my camera on, and there you go. There's the mug. I was going to show I think I'm going to do this in the weekend update, though. I thought everybody would get a kick out of this with all the Chuck Norris talks and everything else. Actually played in a poker game for my brother-in-law's birthday over the weekend. And guess what we used for chips? Nobody had any chips, didn't have enough chains. We used bullets. Bullets were what we were using. I thought that played right into the whole Chuck Norris thing. So watch for that. As a bit of fun in the weekend update. For those of you that may be new, here's how TradeFinder works. We talk about the markets. We'll start with our market, the U.S. market, and we'll look at international markets as well. If you're only interested in trading the U.S. market, please don't tune out when we look at the international markets, because every security that we show trades on the U.S. market. So even though it may be representing another country's market, it is tradable here. And if it has a good Elliott Wave pattern, yeah, why not? You can trade it here. So encourage you to stay tuned through that. We'll do a review of any closed alerts that we may have done for our Elliott Wave options subscribers. That's for our alert subscribers. And we give you an idea of how that works. So I'll share that with you. We'll go through and look for a new case study consideration, as well as revisiting some past case study considerations that you may be following and may be considered to be open. And then we'll do, as Zach said, at the end, a general Q&A with whatever time we have left. That's how it works. So let's go ahead and jump into it. Take a look at our market. As Zach said, we can't get above this 420 level. We're just bumping right up against it, which also happens to be a 50% wave 4 corrective level. So there's a couple things sitting there for the market. The longer we sit there, I think the better chance there is that we turn and move higher. We're still above the 10-day moving average, as you can see. But as Zach mentioned in the intro, big GDP report tomorrow, talking about July. But are we really? I mean, the Federal Reserve has already kind of said they're going to go 75 basis points. Is that what the market's waiting on? What is the market waiting on? It's a really good question, considering the fact that we've gone since the last time we talked, nothing has happened. Absolutely nothing. Look at the market. They're sitting there going dead sideways. So sitting right underneath 420, what's going to be the catalyst? Perhaps the escalating rhetoric between China and Taiwan. You've probably seen that China was upping their military drills. So now Taiwan is ramping up their military exercises as well. So perhaps if there is an invasion of Taiwan, maybe that has something to do with it. I know you hear about the whole monkeypox thing in the news. It seems every single day, but even though there's cases throughout the country, in the grand scheme of things, it's not a tremendous amount of cases. It's not really lethal. I just don't think that has an effect on the market. I think the market's pretty much to the idea that the Fed's going to go another 75 basis points. That's what's baked in. It was 50. It's kind of up to 75 now. Maybe that changes tomorrow. Maybe we get some sort of a bizarre GDP report tomorrow, significantly lower than expected. That could burst the market above 420. And as I mentioned in the past, we have to be careful here, because if the market does break above 420, there's going to be a significant amount of short covering, and that will ignite a pretty decent rally. Maybe if it shows that, hey, this whole inflationary thing is being really stubborn. But if you listen to the financial networks, there actually has been some good commentary. I joke that I leave the financial networks on mute most of the time. Every now and then, if there's a person on there that I have a lot of interest in their opinion, I'll turn the volume back on. But there has been some chatter on the fact that it takes 6 months or so for an interest rate hike to work its way through the markets, and that just hasn't happened yet. Now, over the weekend, I did a written market update, and I showed you a chart that shows that the Federal Reserve had said they were going to withdraw $47.5 billion from their balance sheet in June. Originally, they were going to do the 95, and then they said, okay, we're going to start a little smaller than that because they're being so aggressive with the rate hikes. And in reality, they only withdrew $1 billion of liquidity. So all that excess liquidity is still in the market. Is that what's holding the market up? Very likely is. Now, is the Federal Reserve actually going to start withdrawing liquidity? That will have a significant effect if they do it. But I think the Federal Reserve never expected to be going 75 basis points every month on the rate hikes. So they're nervous about doing aggressive rate hikes and an aggressive withdrawing of liquidity at the same time, and absolutely collapsing or crashing the market. That's giving the Federal Reserve a bit more credit than I normally do, but it does make sense as far as their actions versus what's going on. Why didn't they do the $47.5 billion? The only explanation I can come up with is the fact that they are raising rates faster than they expected to, and they are concerned about just a double whammy smacking the market and pushing things lower. So we're still sitting there, and I know y'all don't like it when I say that we could go up or down from here, but we can. We're in a 5-wave impulse pattern, and the prudent thing to do is wait. If you're trading significantly directionally right now, you're guessing. If the market breaks above 420, there's plenty of time to trade to the upside, because there will be a lot of short covering, and it could ignite a pretty decent rally. And if the market turns and heads lower, you can see where the target is on the wave 5. It's all the way down below 340. So plenty of time to trade to the downside. So don't force things. Just be patient. Watch what's going on. Let the market come to you. Let the patterns develop for you. I think that's one of the things that over the years that I've learned the most, and I like to share with people, is there's times when you just let the pattern develop. Instead of trying to predict what the pattern's going to do, let the pattern develop, because I can tell you there's no one that's smarter than the market. The market's always right. The more education you gain, sometimes we think, all right, well, on everything I know, this is what the market should be doing. but the market doesn't always do what you think it should be doing. It doesn't always do what makes sense based on the fundamentals, based on the news, etc. The market's going to do what the market's going to do. So we're right here. We're at a very important level. So if the market breaks down, again, plenty of time to trade to the downside. You know where the target is. If it breaks higher, plenty of time to trade to the upside. No reason to force things and just guess right now. Hey, if you guess and get it right, congratulations. But you're guessing at this point if you trade directionally. Looking at interest rates, and this is one of the things that I had mentioned in the written market update over the weekend, is I have been really confused by the fact that with the Fed raising rates, the 10-year has just been kind of lingering down here and drifting a bit lower. Now it makes sense. They haven't been withdrawing liquidity. They're leaving the liquidity in there. So that's the reason that interest rates have been coming down, along with some other things. But we're sitting here at right at the 38.2% wave 4 correction. We bounced up a little bit. You look at the 10-day moving average, we're above it, but below the 50. They're all kind of converging here. Something's about to happen with rates. Maybe tomorrow is the catalyst for that. Maybe the Federal Reserve actually starts withdrawing liquidity, and that jumps rates to the upside. We'll just have to wait and see. But you can listen to what the Federal Reserve says, but it makes more sense to look at what they're actually doing. And that's when I did some digging and discovered that okay, now I get it. Now things make a bit more sense. Taking a look at the dollar, that can give us an idea of economic weakness. I think the dollar is probably a better indicator right now than interest rates are, because the Federal Reserve's not doing what they said they were going to do. And we have a pretty nice little symmetrical triangle built here in the dollar. If you've watched any of these things before, you know how I feel. I say it each and every week. I am a fan of a strong dollar, not necessarily this high. So the dollar can come down and come down a bit, could even come down all the way to this wave 4 here. That wouldn't concern me at all. I really wouldn't start to get concerned about the dollar unless we started testing this level down here around 98. If we were to move down that far, I think that's a signal of more economic weakness than is priced into the market. Right now, what's priced in is a mild recession. If it shows that we're going to have a more severe recession, if the Federal Reserve actually does start withdrawing liquidity as well, money stops, that could change things significantly. But until they actually start doing what they said they were going to do, we have to respect the idea that the markets could break higher. We could move above 420. We could have a short covering rally. Those things are possible, even though we're in a qualified 5-wave impulse to the downside. So the dollar, if it breaks to the upside, even if it breaks out of this triangle, are we going to take out this high? Likely not, because it's right smack in the middle of the tap box. It's already hit the forecasted high. Maybe it goes back up to test that. That would be about the move expected on an upward breakout of the dollar. So I don't think that hurts things too significantly. You know, the stronger the dollar is, a lot of companies have been citing this in their earnings reports, that the exchange rate has been a detriment to their earnings. If it breaks much higher than that, okay, well, then we have to start saying that, all right, that's going to be a significant impact on earnings going into the next quarter, and that could move the market to the downside. But I think it has to break that 109 level before that becomes something of concern, a point of concern from there. All right, so let's take a look at some of the other markets and see where they are. The diamonds, as you know, the Dow and the S&P have been pretty much in lockstep recently, and same thing here, sitting right at that level of resistance at 330, just underneath the previous 4 there. So nothing different there. Looking at the moving averages above the 10-day moving average, you can see how quiet the days were. One thing I should show you today is volume. Look how small the volume is. If you're long the markets, that has to be a concern. So if you're long the market, you're hoping for a big surprise on the GDP number tomorrow. You're hoping for that number to come in much lower than expected, and that ignites the rally. That gets us above resistance, and we have the short covering rally that I'm talking about. But this tailing off of volume sitting underneath here, that's the one aspect that could create a move lower from here. Now you're starting to hear some of the pundits in the market say, oh, I don't think the market does retest, where everybody was saying that, oh, we got to retest the lows first. So as soon as everybody starts saying we're probably not going to retest the lows, that's when you have to be a bit more concerned about it. Those psychological things work, they matter. When everybody starts viewing the market one way, the market often goes the exact opposite direction. Look at the Qs. So we broke back below 320 today, but we did stay above the 10-day moving average. So we tapped the 10-day moving average on the low, closed above it. So still okay there, but you want to see the market back above 320 on the Qs, because if we get a follow through to the downside, then we're probably at least coming down to the 50-day moving average again, maybe down here towards that 300 level as well. So important that tomorrow the Qs get back above 320. If you're long the Qs, that's what you want to see. On the IWM, looking at the Russell, we had noted last week that we got right up to 190 and couldn't break above it. Well, we did yesterday, but now we're back testing that break. That's okay. When you break above an important level of support and resistance, it's pretty normal to come back and test that level, especially when we had a bit of a gap up there yesterday. So we filled the gap. We're testing 190. The IWM actually looks a bit stronger than any of the rest of the markets. As you know, President Biden signed some legislation about chips. So let's go ahead and take a look at the SMH as well here. I thought you might be interested in seeing that. And there we go. NVIDIA came out and gave a surprise warning in front of their earnings report. Nobody really was expecting that. So that kind of sent a bit of shockwaves through the entire chip sector. And then moving lower here, looking at the moving averages, the only saving grace here on the SMH is the fact that we hit the 50-day moving average on the low and held it. But a little bit of a gap down, broke below the 10-day moving average. So that's a pretty weak move, probably coming down to test this level of 220 on the SMH, and then we'll see what happens from there. But it looks like a test of 220 is in the works. Now we may bounce and fill that gap tomorrow first. Again, things could change. It's going to take a significant difference in the GDP report tomorrow, in my opinion. In other words, a big drop in inflation, or it's staying stubbornly high and hasn't come down at all to make any sort of a significant move out of the markets. If it's just kind of in line, I don't think that moves the markets. And in that case, I don't really know what does, unless it's China and Taiwan. So we'll see how that plays out from there. Bitcoin. Same story, trying to break above 24,000, keeps going up and testing it, can't quite do it, back down every time we come up. But we do have this ascending triangle here. And if you listen to a lot of the rhetoric that's out on the markets, that an ascending triangle means you're going to break to the upside, can tell you that's not true. A triangle, whether it's ascending, symmetrical, or descending, means you're going to have a break. But it doesn't, you cannot forecast what direction it's going to be. We could break to the downside here on Bitcoin, or we could break to the upside. The one thing that is interesting is, after, when did we start this? Back in the middle of June. And here we are. So nothing has happened really in 2 months, but it looks like that's going to change. So we're right against the 50-day moving average. We're right at 24,000. We've got an ascending triangle. Bitcoin is ready to make some sort of a move. Does it break above 24,000? Does it break down and break below 20,000? We're going to know very soon. Likely before we talk again next week, we'll know whether this happens. It could even happen before our insiders meeting on Thursday night for our alert subscribers. We may already know the answer by that point in time. All right, so let's take a look at the EWA for Australia. And as you can see, all the major moving averages there converging right into a nice, neat little triangle here. Small one, but it's still a triangle. And remember what I've mentioned before, Elliott always said, don't diss the small triangles. Look at those as well. Something could happen when you have any sort of a triangle. People tend to look at the big ones. We do as well with our volatility portfolio, focused on larger triangles, whether it's ascending, symmetrical, or descending. Haven't done a whole lot with that in a bit because the VIX has been so high, but now getting the VIX back down, starting to see some candidates there. And our alert subscribers are probably going to see some strangles come out here within the next couple of trading days as well, which is pretty exciting because it's been pretty quiet on that front. But on Australia, a small triangle here right at the 38.2% wave 4 correction level. So we got a fib level there. We've got 23. So we went right up to 23 as we talked about that back when we were at the lows, that's where we could run and hit some resistance. So we did that, and now we're consolidating. We got all the moving averages converging in a little triangle. Something's about to happen on the EWA. However, with the size of the triangle, it's only 1 point. So if we break higher, we're really only looking to go up and test this resistance at 24. If we break lower, we're going to come down and find a little bit of support there at 22. Then that's where the rubber hits the road. Can we break above 24? Can we break below 22? That's going to be the next directional move on the Aussie market. If you're interested, it's almost not enough to put on a strangle. Just a 1 point move is just not quite enough. If you look at the ADX, it's diving down. It's not quite the 15, which is the level I look for. Now that the VIX is coming down, we're even going to look more for ADX is getting closer to 13. So I don't really think a strangle makes sense right here. It's just not enough of a move. It's more prudent to wait, let the market break out of this little triangle and see where we go. If we run up to 24, if we break above that, again, a lot of short covering. If we break below that, then we're probably coming down to test those lows down around 19. So pretty easy just to wait and see what's going to happen on the EWA. And looking at Canada here, not quite the same sort of a triangle. There is a bit of one, not as well formed, but you could make one there. Also, right underneath an important level there at 35, which happens to just split the triangle. I really like it. Now, if this was a larger move, again, it's only a 1.5 point move. But if this had been a larger triangle and you have support resistance going right through it, boy, that's a great scenario for a strangle. Just an educational thing for you to file away. If you have a decent sized triangle looking for a 10% move out of the breakout, that's what I mean by a decent size, and the support resistance goes right through the middle of the triangle. In other words, that support resistance line is right at the point of the triangle. That's an ideal scenario because that means on a breakout, it doesn't immediately bump its head on resistance or it doesn't immediately find support. It gives it more room to run when you have a scenario like that. That would be a great potential setup here, except it's only a 1 point potential breakout. So same thing as Australia. It's only going to take us up here to about 36, where there's the next area of resistance. And if we break down, same thing. We've got support here at 34. So we'd have to break above 36 or break below 34. So there's a lot of wait and see going on in the markets right now. Hopefully tomorrow that breaks it. I'm suspect of that. I know it's a big GDP report and everybody's looking at it and waiting for it. And perhaps it is. Perhaps it's unexpected to the upside or the downside, and that busts us out. You know, just don't really see it too much so far. The Federal Reserve looks at the PCE. That hasn't come down much. So it's not telling us much either. They look at that more than they look at the GDP report. So here's another little triangle. So all these little small triangles, this one in India, but this is to be expected. Remember, we talked about this vertical move, didn't like that. If you're bullish on India, that's about the best thing that you could ask for is to consolidate sideways. In other words, it hasn't come significantly vertically back down. Now, it could break to the downside out of that triangle and accomplish that. In other words, we could have a downside breakout here back down towards that 50-day moving average and rectify that vertical move to the upside. But if it breaks higher, then it's going to disqualify the 5-wave impulse pattern. Right now, it's still intact. 65% wave 4 is still okay. It's pretty close to that 61.8% fib level. So going vertically up, hitting that level, not too far away from some pretty significant resistance there at 44. All that makes sense. Now, if India can break above 44 with some follow through, you got something there. It's going to go at least to 46, maybe even higher on India if it can do that. But another just 1 point triangle. So it does look like some of the malaise that's occurred over the last week. Basically, we could have just played the recording from last week's TradeFinder and shown the markets to be the same, but at least something's going to happen. It doesn't look like it's too significant, but at least some sort of a directional move based on all these triangles. And then looking at the EWG for Germany, about the best thing you can say for that is it's consolidating as well underneath that 50-day moving average, right at the wave 4, 38.2% fib levels. If you're looking at these, if you're new, if you're watching on the live streaming services and you haven't watched this before, or maybe you're not a big proponent or haven't really experienced Elliott Wave yet, how can you discount all of these patterns, these Elliott Wave Fibonacci levels? They've called every one of these markets that I'm talking about. Every one of them is spot on in their patterns so far. So if you're newer to Elliott Wave, welcome to you. Invite you to keep coming. I think you're going to be pretty impressed with the forecasting prowess of Elliott Wave if you continue to view us. So we hope you will. So right here at 24, breaking above that level would be really significant for Germany. At least we would get to 25, and perhaps if we get above 25, you could always go all the way up to 27. That would be a really significant upward move. But long way before that, we got to break above 24 first, then break above 25. So a lot of work to do there on the EWG. But again, just wait. We've got these consolidation patterns. The triangles aren't really big enough to put strangles on. So just wait, let it make its directional move, and then make your call from there. That's the prudent thing to do. That's what makes sense. All right, so if we move to looking at our alerts, we didn't close any alerts for our alert subscribers, but one thing that has happened that we've been talking about, perhaps you've seen some information on our new AI-based time strategy. We're one of the first. There's a lot of chatter about AI out there, but we're one of the first that actually has a portfolio and a search, an entire system based on AI. It's functioning. We did all the research. We did 20 years of research on it. It's live, it's working, and it's doing extremely well. Now, there's been fewer results than normal because one of the things that we look at is for stocks that have had a drop, earnings season, that happens, and then the AI tells us what's the probability that it stays in a trading range, a 1 standard deviation trading range. You can find information on our website in detail about the strategy. We did an entire masterclass on this. So plenty of information. Go to our website. We've got a lot of people that come to our website just for the education and don't even look at the alert service. But one of the things that I wanted to show you, and we've been telling our subscribers to the AI-based time strategy, that once the VIX starts to come down, you're going to see some more results. And we had this period of time where we had an unusually high VIX for a long period of time. Now we've gotten to the point where the VIX has come down and we're in earnings season. So we're seeing a lot more results. So look, you can see how many have come out recently: 0 days, 1 day, 4 day, 4 days. So we're getting a lot of results now in the AI-based strategy. Look, we're already up 50% and it says 0 days. That alert went out today, 15. Let me be clear, 15%. That only went out today. on this one. The reason it says 0 days is it hasn't been 24 hours yet since the alert went out. So based on what happened from the time the alert went out until the close, so the mark to market is showing a 15% gain already. Hasn't even been a day. This HCAT, not much is happening there. Not much is happening on DHC. We're up 5% on the FT NT here. And then if you take a look at MTCH right here, you can see that we're up 15% there. Now take a look at this. If you're interested in trading directionally, one thing that's of interest here is the fact that you can go from a calendar spread, which the majority of our new alerts have been calendar spreads. But if you do have a slight directional bias, which we did on match, that's what MTCH is, had an expectation that we may move a bit to the downside. So I kind of want to highlight this one. And you can see here that looking at this pattern, there was a bit of a bounce up, but 60 looked like target. Here, bring it to me, I can't see it. Okay. So we look at this, I think I misspoke, CPI rather than GDP. But anyway, that report for tomorrow could move the markets. So thanks for those that all these initials. But going back to looking at match, you can see here moving down towards this level of 60, looking at that potential move to the downside. It bounced up, but that's support. So there was a potential to move up to 70, but then likely coming back down to test that support level. So with that, we did a put diagonal. So this is a debit diagonal. You can actually do credit diagonals as well. So we did a debit diagonal. And as you can tell by the result here, where we went from a slight loss to a 14% gain, match moved back down today. That's what we were looking for. So we're capturing time decay. We're capturing the volatility spike that occurred when the stock dropped. And we have a slight downside bias to this, expecting it to move back down towards that 60 level. If it does, we'll be out of this one very quickly. But look at the turnaround there, 30% change from the low to the high today, based on just the fact that it moved lower today. So I just thought I would share that with you, since there wasn't a closed alert, that we would talk about some current alerts, things that you can watch for, and the fact that if you've been hearing about our AI-based time strategy and you've been interested in it, then hey, no better time than now. The VIX is back down. We're getting lots of results, and our data has been off the charts on how well this has performed with the AI analyzing over 300 data points. So if you're wondering what's the AI looking at, I'd take the rest of the hour and not even cover a fraction of them, but it looks at over 300 different data points to come up with a score of whether or not the stock is likely to stay in a trading range. And if it hits the score high enough, what we're looking for, then we go ahead and send out an alert. So we're super excited about the fact that we're seeing a lot more alerts coming back out again on the AI-based time strategy. All right, so let's look at some of the past case study considerations that you may be following. There's a few that have been left over, and you can see here, Reliance Steel. This one goes all the way back to the 3rd of May when we first looked at that. So starting to put some time in on this one. Right there was the entry, and it moved to the downside, and it's just kind of hovering right at this 190 level. It doesn't seem to want to break this level. I do think it is going to. I think it's going to head back to the downside and likely test those lows around 160. Not really sure what's holding it up at this point in time. If you look at the volume, you can see that we've got quasi doji there and very low volume. So tomorrow may be the day that things start to move there. HZO, had moved higher, lower, and then back to the downside today. As you can see there, it had moved back higher, came down, and then a bit of a bounce back down today. You look at the moving averages, and we're underneath the 10-day moving average again. Needs to get above that 50-day moving average. Had a great earnings report, but you never know how the market's going to view an earnings report. In this case, it came lower, likely on concern about the weakening consumer if we do go into a more protracted recession. But this is pretty easy here. You stay long if it's above 37. If it breaks 37, you go short. Pretty simple on that one. Another one, MOS. We looked at this one back on the 24th of May, and kind of the same thing is Reliance Steel, just going sideways, going nowhere since then. You can see it's in a qualified 5-wave pattern to the downside. They had a lousy earnings report, but the market didn't punish them because they blamed it on supply chain issues. So if you have a bad earnings report, you just say, hey, it's because of the supply chain, and people view that, oh, at some point supply chain is going to get back intact and you can move forward. But it really wasn't a very good earnings report, and yet the stock hasn't tanked yet. We look at volume here to see where it is. You can see that even through the earnings report, it's been on just absolute pathetic volume, about half of the average. So it's trading, it's going sideways on half the volume. Something's going to happen. If it can break above 60 on volume, well, then you go long. But as long as it stays below 60 and it has that kind of pathetic volume, then you have to stay short on that one. That's what makes sense. We looked at Dollar General back on July 5th, and it hit our target. So 260 was our target, and it hit that yesterday. You can see the high there, 259.65. So we're going to cross that one off. That one did what it was supposed to do. So 260, it hit it. It backed off of it. Isn't that interesting that as soon as it hit our target price, it reversed? I don't know. Are a lot of you following that? Did a lot of you sell as soon as it hit 260? But it certainly reversed once it touched 260, didn't it? I say that a little bit in jest, but likely because it got towards those recent highs, which is why we had 260 as our target price as well. So that's a winner. That one's done. Looking at RH, and that one we looked at on the 26th. And so there's where it was back on 26th. And it looked like it was breaking to the downside. It has moved back to the upside, but it reversed today. Give that and see what happens around 260. If it holds above 260, then you probably want to close that position out, maybe consider going long. But if it breaks below 260, then it's going lower. So let's give that one a little bit of time, I think. Last week, we looked at BR, and look at that move. So that was a nice one. If you were with us last week, hopefully you followed along with that one. We said this Elliott Wave pattern had become disqualified, and there we go to the upside. Our target was 170. That's been hit. So it hit it yesterday and today. So if you didn't get out yesterday, you should have gotten out today. So that was a quick winner. So that one won in 1 week. So you can see that these case study considerations that we look at here in TradeFinder can be pretty nice if you follow along with them. The difference between this and our alert service is we show you a potential entry here, and then you're on your own. The trade you put on, what you do with it when you get out, all that. With our alert service, we send you out an alert when we get in, any adjustments, and when we get out. So kind of hold your hand through the entire trade rather than just saying, hey, there's a consideration, do what you want. This was brought up because we did put this on a watch list last week. So I thought I would bring that up, that you could consider this one once the overbought condition was rectified, which has happened. As you can see, last week we were way overbought up in here. Well, I think this takes off if something escalates more out of China and Taiwan, because this is a defense contractor. They're actually local here. Where I live is one of their primary facilities. Bit of a triangle here, so we want to kind of keep an eye on that. So we've got a doji here, right, with all the major moving averages with a bit of a triangle. But we said that we would consider that if the overbought condition got rectified. It has been. Almost maybe makes more sense to see if it consolidates a little bit more and maybe look at doing a triangle, but it would be very expensive because it's a $240 stock. So if you don't have a large account, probably more prudent to wait, let it break out of the triangle. If it breaks above 240, you go long. If it breaks below 220, you go short. Pretty easy to tell what to do directionally on this, and look at the triangle dead in between. So again, above 240, go long, below 220, go short. But interesting with all the rhetoric that's going on around the globe, etc. So we took off a few of our case study considerations that have worked. And so from now, at this point, I'll go ahead and see if we can find something for tonight, and then we'll open it up to questions. So this program, if you're not familiar with it, is called Profit Source. To me, it's the best Elliott Wave software program on the market, bar none. I've tried all the ones that I know to exist, and this has been the most accurate. And part of the reason that I believe it's been the most accurate is it is programmed directly from Ralph Nelson Elliott's algorithm. It's no personal adaptation, which a lot of the software programs are. People take it and they kind of twist it around to their own personal viewpoints. This is just, he wrote this like 20-page code for Elliott Wave. This is programmed directly to that code. No personal adaptations in here at all. Now, something interesting here on the searches, docs, we already have an alert to the upside for our subscribers, our alert subscribers. We already are in this one, so we won't do anything with that. But you can see that some volume today kicking in there. And if this can break above this area right here, notice that for past 4 days it's tried, but if it can break above 88 and hold it, then it's going to go to 94 and hit this target up here. And that would be a really nice trade for our alert subscribers. But it's interesting that it's on the search. It's on the impulse search, which means all of our confirming indicators that we look at, the DMI, the CCI, CMF, moving averages, et cetera, they're all in line as well with the Elliott Wave pattern. So it would be interesting. I'm not going to use that one as a case study consideration for this tonight because we're already in it for our alert subscribers. Let's see if we can find something else. You can see a financial. I find that pretty interesting. And it doesn't look too bad. We're in a wave 5. We take all the other moving averages off. I do want to leave the DMI on there. It looks like, okay, we ran up, came back down, tested 26. That's held. We've kicked to the upside from there. The DMI is suggesting that we go higher on this. Let's see what the options look like. I'm not super familiar with the options here on CVBF, but let's take a look. Yeah, I was afraid of that. There's not a whole lot, and the spreads are, forget that, spreads are too wide. All right, so I was concerned about that one because I wasn't very familiar with it. AJG, I think this one's, I've seen this one before. Gosh, that looks good. Wow, that's a great looking pattern, but I think there's an issue with the options here too, because I know this one's shown up before. If not, this is really trying to power here above this 180 level. That looks really good. So let's see what the options look like here. Maybe I'm remembering it wrong. Hopefully we have some choices here. If so, then that's going to be our case study consideration for this week, because that looks great. We'll look on that NYSE. All right, give us some. Oh, there we go. So perhaps I was wrong on this. The spreads are a tiny bit wide, but not super bad. Yeah, so this is going to be the one. All right, so we're going to look. Let's go back and look at the chart for tonight. 8-9, which is good because we don't have that many left to look at. with that breakout. Now, just a quick note, don't get too concerned if it moves to the downside because we're a tiny bit overbought right now. So if it opens lower, that's okay. What we don't want is for it to break below 180. So as long as, even if it opens lower, as long as it holds above 180, that's going to be our case study consideration. So we'll see how that trades in the morning. So I'm going to make a little note here. If it holds 180. So then we would look to the upside. All right, that looks pretty darn impressive as far as breaking to new highs. Again, tiny bit of concern on the overbought condition, but that's just short term. So we just want to try to get the best entry that we can get. All right, Zach, with that, take some questions.
Sounds great. Thanks for that wonderful presentation, Rob, as always. We've got tons of great questions and comments coming in from the multiple different platforms and, of course, our Zoom audience. We'll start out first, as there's been multiple comments from YouTube subscribers discussing Tesla and the recent hefty amount of shares that Elon has sold. So that might be an interesting one to look at.
Well, I don't blame him. Why wouldn't he just cash out of everything? How high is this stock going to go? How many chances is he going to get? You can see the volume there, average volume on the move lower. And we haven't quite disqualified this Elliott Wave pattern. So could we move lower? Now, a couple things to note here from a technical standpoint, and what we talk about to our volatility portfolio subscribers all the time on these triangles, that once we break out and we run, and that's about exactly where it was supposed to go from the breakout of the triangle, these breakouts get retraced. Now, same thing with gaps. The issue is you don't always know when. Sometimes the gap gets filled immediately. Pardon me, sometimes it takes some time. Looks like maybe we're trying to come down and fill this gap pretty quickly here. So no harm, no foul on Tesla as long as it holds above 760. If it breaks above 760, then we're coming down here to these lows here at 640. So we're below the 10-day moving average today, but that's just one day. So if it gets follow through, specifically if this gets followed through tomorrow, then we're probably coming down and we're retracing that entire triangle breakout. But if you're long Tesla, don't worry about it. As long as it holds above 760, and I know that's easy to say when it's trading at 850, you're like, yeah, that's 90 points lower, but it's a high dollar stock, and as you can see, it moves a lot. So that's the thing there. I still think you stay long if it stays above 760. If it breaks that, it's a whole different story, and then it might be a good short because 640 is in the cards. Then that's 120 points. Even lower from there.
Very well, thanks, Rob. Yeah, that's very intriguing. Going to be a fun one to watch. I mean, it always really has been, but especially now, it will be quite eventful. All right, so we'll transition back over to our Zoom audience. Both Larry and Susan had a similar question. Is there any significance to the SPY charts relabeling from last week where it showed a 5-wave with the July low and now it's relabeled as a 3-wave low?
Well, thanks, yeah. When you relabel, it's because it's done what it's supposed to do. So that was a wave 5. It's supposed to go back to the previous 4, and it did. So once it does that, then the algorithm recalculates. So see, there's the wave 5 there, and it's supposed to go back to the previous 4. Now, once it does that, which it did, then the software says, okay, it did what it was supposed to do. You had a wave 5 low labeled there, supposed to go back to the previous 4 because it wasn't 100% wave 5 extension. Now what happens? Well, the software is saying that there's risk we could be moving lower from here. And we have a perfect 50% wave 4 correction. So I think we have to be really leery of that. But we are so close to 420 that, as I said, if we do break above that 420 level, then there's going to be short covering, and this probably becomes disqualified. So the software is just trying to figure out, we completed everything we were supposed to do. The 5-wave pattern to the downside, the retracement back to the previous 4. Where do we go from here? Oftentimes you move into ABCs here. but it has chosen to label this as a 5-wave impulse to the downside. So it's something to pay attention to here. And yeah, maybe that CPI report tomorrow is what really generates things. Again, thanks for creating, I believe I said GDP. That's the end of the month. So let's see what the CPI says tomorrow.
Yeah, no worries. And I think that might have been my fault because in the beginning I said GDP, so I might have got stuck in your mind from that. So, CPI was obviously what will take place tomorrow. I think the GDP is on the 25th.
Yeah, the GDP is always the end of the month. So, well, thanks for trying to take the hit on that, but it really wasn't. I don't think. Anyway, let's move forward.
All right, we'll transition back over to YouTube. Howard says, "Eye on the VIX. I would have expected a little more of an uptick over the last couple of days with the incoming economic data. The fact that it remains low, is that a tell for the next leg up?"
Could be, but that's been a pretty strong march to the downside here. It's an odd place to catch it if it does at 21, right? I mean, 20 has been an area that seemed to be support resistance for quite some time. And then if it didn't hold that, then back down to 18. So just a little bit above that, but it's been a pretty significant march lower. And so getting some of that ridiculous volatility out of the market is what's allowed the AI to say, hey, now we can score some of these potential range bound stocks a bit higher. It takes it into account. Obviously, if the VIX is high, the market's volatile. And if you're expecting a stock to stay in a 1 standard deviation and the VIX is at 35, even though the stock's had a big drop, it's less likely. And so the AI scores it that way and keeps us from putting the positions on. But now we can. But I wouldn't be surprised to see a bounce from here back to the upside on the volatility being down this low. But I wouldn't be surprised to see it come a little lower and test 20. Tomorrow could be interesting. I just don't think it's a significant market mover, but it could be wrong. It could be a surprise number. That's what it would take, I think. But we're getting near an area that I just don't think the volatility is done in the market, but it is nice to see it break out of that range between 25 and 35 and open up some more trading possibilities here. But, the rest of it, 420 is so key. All right, I'll shut up so we can get some more questions.
No worries. There's been a few comments about Roblox in the YouTube chatter, which I know we looked at last week as well. But
well, it's the earnings report after hours that, and then they start talking about all of the people doing things on Roblox and the metaverse, et cetera. So that's not reflecting what happened after hours. Big move to the downside. Let's see exactly where it is after hours. So we may be starting that wave 4 now. Yeah, it's down to 39. So we're going to, it's right at support. So you're going to come down there. I may label that. It's right where the wave 4 is. So that kind of makes sense, doesn't it? So it's going to gap down to that level there of the wave 4. And we'll see if it can hold there. If it can't hold there, then you're looking at 30. So if you're long this stock, you want to see 40 hold tomorrow. So if it labels the wave 4, we got a gap to fill. It doesn't feel good, but no harm, no foul. You could be bouncing back to the upside. But if it can't hold 40, then 30 is an easy move to the downside because that was just a 45-degree angle move from 30 to 40. So it'll be pretty quick back from 40 down to 30. But it can label this wave 4 and hold support, and then you're okay. So 40 is key. And I knew this one was going to come up. I saw that after hours, and I knew that was going to be a point of topic tonight. Because I know a lot of people have been looking at this really nice wave 3, but poor earnings report. But the future is good for this, right? I mean, there's more and more stuff happening on the metaverse. So if it went down to 30, I think that would be an amazing entry to go long. If it holds 40, that's still a pretty decent entry there. So if you're already long, maybe you add to it. it kind of makes sense. It ran up here, resistance, and then it was the earnings report to move it lower. So watch 40. That's the key there.
Very well. Thanks, Rob. So we got a couple comments from subscribers on YouTube and Zoom that would like to look at gold GLD.
Oh, we haven't looked at that in a while. So I was wondering about that myself. So appreciate the people asking. How long have we been waiting for some sort of a bid in gold? Been quite a while. And so we held this area at 160. 165 was nice to break, but it wasn't a major point of resistance. There was some going back to last year around this time, just not so much recently. But it is nice to be above 165 regardless because of the past level. But currently, as you can see right here, what we're looking at is 170. So we're in a 5-wave impulse to the downside, but we're building the wave 4. So there's no way to know when that's going to end. It hasn't even hit a 38.2% wave 4 correction. But man, if we could get gold above 170 and then somehow get above 175, then we could be off to the races on gold, and that would really make sense. This is another thing. The whole interest rate thing has confused me, and so has gold. With the dollar coming back down, why hasn't there been a bid? Well, finally we got one. And so we're going to have some resistance at 170. If it breaks that, it's an easy move to 175. And then that'll be where, okay, can we get above 175? Then maybe we're off to the races here in gold. But it's nice to see a bid there. So appreciate you guys asking for that, because it's been a long time since we've been able to say anything positive about gold or silver.
Absolutely. Yeah, that was a good chart to bring up there.
By the way, real quick, I started to interrupt you, Zach, but the DMI is showing that the likelihood is that we are going to go up and break that 170 level. And then if we hit 175, then we'll have to see where the DMI is there. But it's showing that this has some strength behind it. If you're not familiar with the DMI, it's one of our favorite confirming indicators, and it measures the strength of a trend. So what it's telling you is that there's probably a little more than just a wave 4 bounce to this move, that there is some strength behind it. All right, I know we're after 10, but let's get a couple more real quick if we can.
Yeah, absolutely. I'm always happy to stay on as long as you are. So we'll come over here to Zoom for a question from Susan. Some of the case studies have what seems to be extended waves with significant moves up and down in that extended move on way to the next wave. How can you know that the pattern isn't breaking on its wave? One of the first case studies had a very long wave 4. Thanks.
Well, I mean, the market is, and this is what Elliott Wave does, and this is when you learn about Elliott Wave, this helps you. That's why we have confirming indicators. I think Elliott Wave is the best technical indicator that exists in the market, bar none. But I would never try to encourage anyone to rely on only one technical indicator, even something that's as good as Elliott Wave. That's why we have a whole set of confirming indicators that we use to back up what Elliott Wave's saying. Is there strength in other technical indicators confirming what the Elliott Wave is telling us? If it is, then we feel like we have something really special. And so that's what we use for sending out alerts. But the market is a series of impulses and corrections. And that's what Elliott Wave is so great at analyzing. And so you have to trust the pattern. And it's hard, isn't it? Like if you're in an upward trend and you're correcting to the downside and your position is losing money and a little bit of time is going by and you get nervous and you get anxious, it becomes difficult to stay in the position. So trust the pattern. Find a system that you have confidence in. Nothing's 100%. Nothing is ever going to be 100%, but find a system that you have confidence in, get really good at it, and then trust it. And more often than not, your patience of going through those ups and downs and those whipsaws, the impulses and corrections that occur in the market work themselves out, and the larger pattern normally does what it's supposed to do over time, but sometimes it takes a while. So, and that's a great question and comment, because that is the difficult thing of trading, right? Is staying committed to a position when it's going the wrong way. Now, if the pattern changes, that's different. And that's when we will make an adjustment at EWO Trader, EWOtrader.com, Elliott Wave options. We'll make it if the pattern changes, rather than just accept a loss and walk away. If you have a qualified pattern in the opposite direction, well, why not adjust and follow that? And we will do that rather than just taking a loss and leaving it. You know, it's everybody has different views, but over my experience, that makes more sense. All right, one more.
Absolutely. I'm on board with you there. And we'll finish on a fun one here from YouTube. Will would like to look at GME.
Oh, that is great. Because that was the headlines on the financial networks. Meme stocks are back. Yeah, that was the headline. So yep. You know, figure this out. And this would not be happening if the Federal Reserve was withdrawing liquidity. I can tell you that, but they're leaving that excess money in there. So you look at this, and that's pretty impressive that GameStop broke above 40, especially when you have this big long triangle here. Now that's a breakout and a test. So the key here, be careful, don't jump the gun. It broke out, that's a clean breakout day, but it's testing it. That doesn't necessarily mean that we're off to the races again, but it could, because the breakout was on above average volume and the test is on low volume. That's what you want if you're looking for something to go long. So there is a chance that maybe GameStop takes off again, but wait and see what happens tomorrow. So confirm or significant breakout, not confirmed because we tested the breakout today. So it hasn't been confirmed yet, but you have a high volume breakout and a low volume test. More often than not, that means that that breakout is likely to hold, but more often than not is not 100%, and more often than not is not when you initiate a trade. See what happens. Wait and see. Does it bounce back above 40? If it does, then GameStop could be off to the races again. It could. That's a large ascending triangle that has a lot further to go. It's a 20-point triangle. So that means you could be looking at GameStop up around 55 or 60 again if this breakout jumps back to the upside and gets confirmed. Thanks, everybody. Thanks for all of you spending your time on the social media services, live streaming us. We very much appreciate it. Time's the most valuable asset we all have. We really sincerely appreciate it when you spend some of it with us. And in turn, we try to make that an informative and educational use of your time. And I hope you found that tonight. Thanks, everybody. Take care. Look forward